U.S. markets rose despite weak jobs data. The Dow rose, as you can see there, almost 1% or 400 points. The other indices making modest gains there as well. That was after payroll company ADP said the U.S. lost 32,000 private jobs in November. It marks a sharp drop from the 47,000 jobs gained in October. Now, meanwhile, data from the Institute for Supply Management shows a mixed picture for the U.S. economy. It said earlier the services sector is expanding. Any measure above 50 indicates growth. But tariffs are taking a toll. That was especially true for the manufacturing sector, which shrank for the ninth month in November. Tom Derry is the CEO of the Institute for Supply Management, and he joins me now. I'm wondering what your read is on the latest data, because I have to say sometimes there's a lot of noise accompanying this data right now. I mean, how do you see it?
Well, I see it as a pretty mixed picture, as you said, Paula, early on. I mean, we are seeing contraction in the services sector, which is by far the largest component from a GDP perspective of the U.S. economy, almost 88% of activity in this country. But it's not strong enough to overcome the weakness in manufacturing right now. In fact, we calculated ISM based on decades of data that the economy today is growing at a 1.3% rate annually, which is quite weak. And I think, frankly, is where the long-term trend is headed in terms of GDP growth in the country. So it's not a good signal. One could almost say that the prospect of stagflation is right around the corner.
Oh, wow. That just gave a lot of people chills, just you saying that. And again, you're looking at the trend line because a lot of the data we're looking at is in the rearview mirror. What do you think is contributing most to this risk of stagflation then? Do you believe it is the tariffs? Do you think partially it has to do with the job slowdown, perhaps leading into AI? I mean, what do you see?
Yeah, well, I think tariffs do explain an awful lot of it. And here's what's happening. Because tariff policy has been very fluid and uncertain, companies are not sure how to plan for it, and they're being very cautious. And that comes through in the data we collect every month. Lots and lots and lots of comments about we just can't see the future. We don't know what the demand signal is, and so we're holding back. And in an ordinary economy, when you didn't have these tariff issues overhanging decisions that business people have to make, you'd see routine ordering and stocking up in inventories. And we've seen a very different pattern. In December and the last quarter of last year, we saw a massive wave of imports into this country anticipating tariffs and trying to buy ahead to get inventory into the country before tariffs were imposed. Then we saw a massive drop off in imports in the second quarter. And so we went from a 0.5% contraction in the first quarter GDP because imports subtract from GDP to a 3.8% growth rate in the second quarter because we weren't importing anything. And now, because imports again are low, we're seeing this rate drop down, this GDP now real growth rate get down to about 1.3%. So I think if you've kind of taken into account Q1, Q2, and now Q3, that's really the long-term growth rate of the economy. And with inflationary pressures building in supply chain, and remember, the prices paid index for both manufacturing and services continues to be very elevated. So the component parts, prices that companies are paying for the things they need to build their products, they're going up. And we know for a fact that most companies have not passed along the impact of tariffs to their end customer yet. About a third of companies have done that, but 2/3 have not. So inflation, as it will be felt by the consumer, has yet to appear, but it is coming.
But it is coming. And in fact, some companies, I was interested in your notes about that because some companies have been warning about it. We've seen it anecdotally, but you're saying we're going to see it in the data very soon. You know, I am curious. We have the president, the White House talking about trying to bring down the price of cars. But one thing of interest that he notes, he wants to bring manufacturing back to the United States, whether it's in autos or anything else. Do you see any signs of a rejuvenation, of a renaissance here for American manufacturing?
You know, it's a split picture, I would say. We definitely see indications that some companies are exploring what are our domestic options? Are there domestic suppliers? Can I reshore operations to the United States? But an equal number of companies, frankly, are looking for a third country of origin. So maybe if it was China before, but now it could be Indonesia or Mexico. And by the way, Mexico is really benefiting because if your products can be imported to the United States under the existing USMCA, the effective tariff rates in some of those products are only 1 or 2%. So rather than manufacturing coming back to US shores the way the administration would like to see it, it's actually the supply chain is sort of diffusing globally.
Right.
That's what's